Welcome everybody to the new year. This is George Veter of Veter Financial. Last week we had an explosion of a couple of specific issues of beaten down stocks that caused a frenzy on Wall Street. So we ended up having a net loss for the week in January, even though we still are holding on to phenomenal gains. The Dow is over 30,000, which is an incredible landmark, but we had gone all the way over 31,000 before this drop last week. So we had about 1,000 point swing, which sounds like a lot, 1,000 points. When you see it on a headline, the Dow loses 1,000 points, that sounds scary, but 1,000 points isn't what it used to be, right? But I was looking back to 2015, and we had what we called a flash crash then. We had a crazy trading week. Nobody really knows for sure what happened. There's a lot of different conjecturing of it might have been this and that. All we know is that there was a huge drop, and it was blamed on program trading and algorithms and maybe somebody inputting some sells or some buys wrong into the system that caused more buying and more selling. And regardless, we lost 1,300 points in a week, but that's when the Dow was at 16,000, which was just 2015. So 1,000 point loss was obviously much more impactful with Dow 16,000 than it was at Dow 30, right? About twice as impactful. So 1,000 points doesn't scare me anymore. That's just that's a 3% movement in the market from where we sit today, which is not even a correction. That's a third of a correction. A correction that we know come every year, just in the normal trading pattern of the stock market. Typically, we get corrections every year. We expect them. That's a 10% pullback from the high, as defined by the market. Also, we have periodic bear markets, which is a 20% pullback from the high. And we know those are a part of economic process. And even though we don't like them, we accept that the market works that way, that it averages up like this, not in a linear line. And just by way of memory, the last bear market we had was only in 2018 from September to December. The market lost a little over. The market is defined by the Dow or measured by the Dow or the S&P was a 20% pullback. And that was just a couple years ago. So as has been the case with all big pullbacks, it's never been the smart move to panic and go to cash during a fearful moment. And then you miss, the inevitable recovery moment. We know that we've had, since the Civil War, approximately 34 recessions. That's based on the data that the government keeps. U.S. Bureau of Statistics, Economic Statistics. And we know that of those 34 recessions, we recovered 34 times, didn't we? It's never been game over. And the world, when it seems really crazy, that's probably it's probably being hyped by the media, or fuel is being put on the fire, so to speak, by the media, because the more they sensationalize a headline, the more viewership they get, right? The more interested we become, the crazier the problem appears to be. So they have no incentive, they being the media, to water down a headline. They like to blow a headline up, so to speak. So we just try to remind ourselves that we're playing the long game. And I have a general faith that the market continues to become less volatile over time, though there are going to be periods of volatility. We didn't have a Federal Reserve until 1913. We didn't have FDIC insurance until the Great Depression, 1933. Oil right now is at $53 a barrel. Just in 2008, the last economic crisis, it peaked at $166 a barrel. Back in 1980, when Ronald Reagan was president, oil was at $125 a barrel. So as a consumer and as an economy, we have a lot of things that we are not focused on that are huge positives. They're not making a lot of news. What about historically low interest rates, right? Talked to a client this morning that told me that he got a big building refinance for 2.2%, 20% fixed. Isn't that amazing? So access to very inexpensive money, banks that are solvent, a financial system that has done better than anybody guessed, as far as if we'd have looked at the pandemic ahead of time. Everybody feared when we moved into a freezing kind of posture in March. We shut down the economy to prevent more infections. We thought that it was just going to devastate our economy, and it did really hurt certain sectors, but other sectors flourished, right? And as a whole, the economy has done better than most of us expected. And now we're looking at a greater robust movement of the recovery, right? Because businesses are opening back up as it makes sense to, and we have this pent-up demand for consumerism. Talk to clients every day that are booking trips, cruises, vacations. They're getting their vaccinations, right? And which is emboldening them to get out of their homes and do things and spend their money. So I've read lots and lots of articles, and my research would lead me to believe that I feel like we have a big consumer boom that's coming. We need to get ahead of that, right? We just need to play our long game. We need to invest and not worry about the momentary craziness of trading patterns, because it's always going to be that way. The market is driven by fundamentals and emotion, and some days emotion is steering the bus, and that means it's not going to be sensible to us, sometimes on the upside, sometimes on the downside. But if we have the long-term view, we shouldn't be making long-term decisions based on short-term feelings of the market, right? I always compare it to real estate. You know, if you learned that housing was slowing in your area, you probably wouldn't put your house up for sale because you heard housing slowing. In fact, you might think about buying your neighbor's house, right? Because it's a good time to buy. I was raised in the cattle business. If cows are at an all-time low, that's not the time you want to sell your herd. It's probably when you want to increase your herd, right? We know pragmatically that you should be buying low and selling high. Now, we don't know what low and what high is until we have hindsight. So if we trust in this process of free enterprise that it works, if you are properly allocated and diversified, and you have somebody watching the shop and making little decisions to make it as safe as possible based on your goals and what the portfolio design is, in my opinion, the reason I'm in this business is because it's the best way to maintain and to grow your wealth over the long term. And we're in the long-term business. If you get scared or a headline freaks you out, please pick up the phone. But we'll try to do these video blogs so you know how I'm responding to it or what my thoughts are. We're a team and we're a family, and we get through these things together, and we make good decisions to create long-term success in our portfolios. So once again, I'm so grateful for all of you that are going to be listening to this. That means you're a client or you're looking into being a client perhaps. I want you to know that I care deeply about what I do for a living. I take it very, very serious. I try never to be emotional, but to be pragmatic and to have perspective in decisions I make. And I realize that it gets scary sometimes, gets scary for all of us sometimes when the world gets negative or craziness is going on. But I will be that calm, steady voice in the storm, always, and guide us to where we need to go. So I'm grateful. Thank you. Happy New Year again at the end of the first month.